Hey everyone, welcome back to Corporate Decoder. Today we're diving into the Gorman-Rupp company's financial report. And let's just say things are getting interesting because it looks like their business is really pumping out some wins. So what we have here is a look at Gorman-Rupp's performance for the quarter ending June 30th, 2025. Think of it as a quarterly checkup for the company's financial health, showing us how they're doing in the short term. Let's jump right into the numbers that really matter, the financials. For the 3 months ending June 30th, 2025, Gorman-Rupp reported net sales of $179 million. That's up from $69 million in the same period last year. So that's a pretty solid jump of over 5%. Looking a bit deeper into where that sales growth is coming from, the municipal market saw a nice boost of $3.5 million. This is apparently thanks to all the investment in water and wastewater projects. The fire suppression market also grew by nearly $3 million, and industrial and petroleum markets are showing good signs too. However, it's not all sunshine. The agriculture market is down over $1 million, likely due to farmers having less income. Now, when we look at how much it cost them to make their products, the cost of goods sold went up by about $7.5 million. That's a 6.5% increase. This means their profit margin, or gross margin, dipped slightly from 31.9% last year to 31.3% this quarter. This little dip is mostly because the cost of raw materials went up, but they did manage to make up some of that by being more efficient with labor and overhead thanks to those higher sales. Then we have selling general and administrative expenses, or SG&A. These costs were $26 million, which is about 14.5% of their sales. This is a pretty stable percentage compared to last year. Putting it all together, their operating income, which is the profit from their main business operations, came in at about $26.9 million. This is a slight increase from last year's $26 million, so despite the higher cost, they managed to keep their operations profitable and even grow that profit a little. Their interest expense, which is what they pay to borrow money, went down significantly. It was about $6 million this quarter compared to $9 million last year. This is great news and is mainly because they refinanced some of their debt and also reduced the total amount they owe. And then there's this other income or expense category. This quarter, it was a small expense of about $500,000. Last year, it was a much bigger expense of over $6 million. The difference there was largely due to some one-time costs last year related to refinancing their debt. So when you add all that up, their net income, which is the final profit after all expenses and taxes, was about $15.8 million in the same period last year. Basically, they nearly doubled their profit this quarter. Now let's look at the first 6 months of the year. Net sales grew to $343 million from $328.8 million last year. That's a 4.3% increase. Again, strong performance in municipal, fire, petroleum, OEM and repair parts markets drove this growth. But like in the quarterly results, agriculture and construction sales saw a decline. The cost of products sold also went up, and their gross margin for the first half of the year edged down slightly to 31%. From 31.2%. This is due to those rising material costs we talked about and a bit more in labor and overhead costs as a percentage of sales. SG&A expenses in the first half of the year were about $51.1 million, which is a small increase from last year. As a percentage of sales, it's actually improved a bit, going from 15.2% to 14.9%. This resulted in operating income for the first 6 months of the year being about $49 million. A bit higher than the $46.5 million last year, so their operating profit margin improved slightly. And again, interest expense for the first 6 months was drastically lower, falling from $91 million last year to just $12.2 million this year, mainly due to that debt refinancing. All of this translated into a net income of $27.9 million for the first 6 months of 2025. This is a huge jump from $16.2 million in the same period last year. It's a clear sign that the company's efforts to manage costs and improve sales are paying off. They also talk about adjusted earnings per share. For the second quarter, their adjusted earnings per share was 54 cents last year, and this year it's 60 cents. For the first 6 months, it's 84 cents last year, compared to $1.06 this year. This adjusted figure basically removes some one-time cost to give a clearer picture of ongoing operations. Now let's look at their balance sheet, which is like a snapshot of what they own and what they owe at a specific point in time. As of June 30th, 2025, their total assets were $861.8 million. What's interesting here is their accounts receivable, which is the money customers owe them, increased to $98.7 million. This can sometimes be a sign of slower customer payments, but it also comes with increased sales, so it's not necessarily a bad thing. On the other side, their long-term debt decreased to $318.6 million from $348.1 million at the end of last year. This is good because it means they're paying down their debt, which reduces their financial risk. Their total equity, which represents the owner's stake in the company, increased nicely to $397.8 million from $373.8 million. This increase is a result of their higher earnings and is a positive sign for shareholders. They recently did a big refinancing on their credit agreements on May 31st, 2024. They now have a major term loan facility and a revolving credit facility. This means they have access to a lot of borrowing power if they need it. The interest rates on these loans are tied to SOFR, which is a benchmark interest rate, and they've also entered into interest rate swaps to lock in a more predictable cost for a portion of this debt. This is a smart move to protect themselves from rising interest rates, and they've also entered into interest rate swaps to lock in a more predictable cost for a portion of this debt. This is a smart move to protect themselves from rising interest rates. They're managing their interest rate risk really actively. They estimate that if interest rates went up by 1%, their interest expense would increase by about $1.7 million annually. But because they've locked in rates for a good chunk of their debt using those swaps, they've really reduced that potential impact. They also deal with foreign currency risk, mostly with the Euro, Canadian dollar, and a few others. They manage this by trying to price their products in the same currency that they buy their materials in, which helps to balance things out. Their foreign currency gains and losses are pretty small, so it doesn't seem to be a major issue right now. Now, let's talk about risks, because every company has them. One big risk they're highlighting is US trade policy and tariffs. They're worried that tariffs on imported materials could increase their costs, and that tariffs imposed by other countries could hurt their international sales. They're trying to deal with this by raising their prices, but it's definitely something to keep an eye on. So what's my take on Gorman-Rupp? They seem to be doing quite well. Their sales are growing, especially in key markets like municipal infrastructure, and they've managed to almost double their net income compared to last year. The refinancing of their debt is a big win, reducing their interest costs and their overall financial risk. They're also proactively managing interest rate risks with those swaps. The main challenges seem to be those rising material costs, which are slightly squeezing their profit margins, and the potential impact of trade policies on their business. The dip in the agriculture sector is also something to watch, though it's not their biggest market. Overall, Gorman-Rupp looks like a stable company with a clear strategy that's paying off, and they're prudently managing their financial resources. That's our deep dive into the Gorman-Rupp company's latest report. What do you think about their performance and their strategies? Let us know in the comments below. If you found this helpful, give us a thumbs up and subscribe for more corporate breakdowns. And don't forget to join our Discord community. The link is in the description. Thanks for watching, and we'll see you in the next one.